Good morning and welcome everyone. It is Wednesday, March 25th. Welcome to Trading Places Live here at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Overnight and this morning, we did get some good news in that the White House and the Senate struck a $2 trillion coronavirus stimulation package or stimulus package. And for me, I think everybody probably knew it was coming. So I think the biggest concern with the stock market continues to be the actual coronavirus itself and whether or not we can contain it and how long it will take and what the ultimate impact is going to be. I think that still is where the uncertainty comes in. And I think that's what the market is going to remain focused on. Don't get me wrong, the stimulus package was a good thing. We knew it was coming. The Federal Reserve has already indicated that they will backstop just about anything with their unlimited QE. So it's not our economic response that I'm most concerned about. I'm really concerned about whether or not we can continue to socially distance ourselves and do the things necessary to beat the virus, to delay it, because really it's a time battle. We know we have scientists all over the world working on vaccines, working on treatments, and so forth. And it's also about not overwhelming our healthcare system. So all of the efforts are going to be really important, and that will translate, I think, into how the stock market reacts here over the next couple of weeks. Had a big day yesterday. Does that mean the bottom is in? I think it's too early to make that call. I'd like to see a lot more buying in the short term before I would begin to think that maybe that bottom is in. We've seen these bounces. I mean, yesterday was historic. The 11% gain on the Dow, and I'm going to go ahead and pull this up for you. You can see here the 11.37% gain on the Dow. I believe I read it was the biggest gain on the Dow in one day since 1933. That is a long time ago, 87 years ago. So, doing something you haven't done in 87 years is a pretty big deal. But of course, we know it comes on the heels of decline. So everything we have to take, keep in perspective. But let's go over some of these numbers because it was finally a really good day on Wall Street. Dow Jones up more than 2,100 points, up 11.37%, as I mentioned. The S&P 500 up more than 200 points, 9.38%. The NASDAQ 557 points, so up 8%. And then we had the mid caps also participating, small caps as well. Excuse me one sec. Now let's take a look at some of the individual sectors. We had energy up 16%, industrials 12.6%, financials 12.4%, materials nearly 12%, and utilities a little under 11%. So these were our leaders yesterday. Of the aggressive groups, really industrials and financials were the only two groups that were leading to the upside. So, when I look at this, I think it could have been better. I mean, the percentages obviously were very good, but in terms of the makeup of the rally, I would have felt much better if all five of the aggressive groups were up here, because these are the groups that depend on future economic growth to continue their move to the upside. So we want to see the I don't want to say economically sensitive because they're not that necessarily. I mean, industrials and financials are more than the others, but these are growth areas. And we really like to see the growth stocks performing well because that would give us an indication that the market believes that the economy down the road is going to be better for those types of companies. So I look at this and I just kind of say this is a mixed picture based on the groups that are leading. And I know there have been some areas of the market that have been absolutely crushed. And it makes sense that when we start talking about a relief package and bailouts, that some of these companies probably would lead that rebound. But that to me is just an initial phase of recovery here in the market. I would be looking a lot more toward, the next few days. Do we continue to rally? Can we take out key levels? And can that money rotate into the areas that are going to benefit from economic growth ahead, or the potential? Those are some of the things that I'll be looking for as we move forward. 10-year Treasury yield. Let's get an update because it does move rapidly. Sometimes we're currently at 0.0 or 0.855% right here. You can see it's been a volatile ride in the Treasury market as well. It's not just equities. Treasury market's been all over the place, but you can see the at least a short-term bottom earlier this week going in. We're trying to rally off of that. And of course, the big bottom put in down on March 9th, which by the way, coincided with the March 9th bottom back in 2009. Let's see, economic reports. Do want to mention yesterday, the PMI composite flash came in at 40.5, well below the estimate, 44.2. February new home sales, though, came in better than expected. But again, that was February. I think as we get into March, we're going to start seeing some a different story. This morning, durable goods came in better than expected. And if we strip out the transports, it was a little less than expected. But again, we're talking about February. I think March economic reports are going to be ones that are going to be most important. We do have March consumer sentiment coming out on Friday. Expectations are 92 versus 95.9 in February. And a big one tomorrow, initial jobless claims. Last week, we jumped to 281,000. Consensus for this week, 1 million. And I think that's a low number. We'll see what happens tomorrow, but I think that's going to be a shocking number for a lot of folks. Let's move on to talking technically. I wrote a brief article this morning in Trading Places. It's really hard to write a lot about one chart, and I could probably spend the next 25 minutes just talking about this chart, but I'll try to condense it a little bit. What I've done here is, and I don't talk a lot about gold because I'm not a real big gold fan. I think gold has its place in a portfolio, maybe in a diversified portfolio. I tend to not be particularly diversified. I tend to go with the trend and stick with it. And when the market gets fearful, my choice is generally cash. I'm normally not moving into gold, but I thought this would be a good opportunity because there are some characteristics that I think, you know, if you're following the market and you want to have a little bit better feel on gold, I think that there are some things that we can talk about. So let me explain what's here first. Gold versus the S&P 500. So this is just a relative chart here at the top, telling us how gold is performing relative to the S&P. So here, when you see these big moves up, doesn't necessarily mean gold is moving higher. It means that gold is doing better than the S&P 500. Next panel here, this is the dollar, the chart of the US dollar, and you can see that since 2011, these lows, the major lows have been getting higher, the highs have been getting higher, and so we have an uptrend in play. Just wanted to point that out. S&P 500, long-term bull market, secular bull market, in my opinion, still in play. Now, this is obviously we're going to have to see how this plays out to decide whether or not this is part of something bigger. And honestly, I think our response to the coronavirus and how we deal with it is going to have a lot to do with how this works out in the end. And I can't predict how, not only here in the U.S., how we're going to react to it, but really around the world. This is a global problem. So trying to use technical analysis and prior price history to predict what's going to unfold with coronavirus, it's impossible. And that's why when the market gets fearful, I say you can throw your technicals out the window. It's really about the sentiment. It's about the fear, and it's about ultimately the reduction of fear, because that's what's going to stabilize the stock market. Not, in my opinion, not necessarily $1 trillion or $2 trillion or $5 trillion package. It's going to be folks beginning to feel like, okay, it's not as bad as we thought, or the worst at least is behind us. We have brighter days ahead. When people start thinking that way, the bottom will be in. So I still think the long-term secular bull market, remember 1987, we had a crash very similar in percent to what we have right here. That was part of a secular bull market. You would have had a lot of trouble convincing people back then that it was part of a secular bull market, but history tells us it was part of a secular bull market. I believe this is still part of a secular bull market. I'm still very optimistic. I tend to be a pretty optimistic person, but we have some issues we have to deal with in the short term. And I don't know how those issues are going to be dealt with. So again, there's definitely a variable there. Below the S&P 500, you can see a 5-day moving average of the VIX. And how you do this on stock charts, if you're not familiar, you can go down and put the price in of the VIX, And then when you come across here under style, put in invisible. So this hides all the daily data. And then if you have an overlay, a 5-day moving average, that's how you can get this to display on your chart. So the only thing that's showing here is the 5-day moving average, because otherwise the daily VIX, it's really jumbled, kind of goes up, then it comes back down. I think the 5-day moving average, for me anyway, kind of smooths out the data and makes it a little bit easier to read on a chart. And then finally down here at the bottom, I've got a correlation, and the correlation here is the relationship of gold versus the S&P 500. In other words, is gold outperforming or underperforming? And that outperformance or underperformance is being compared to the VIX. And the correlation of those two is shown on this chart. So you can see that there's generally a very positive correlation. So in other words, when the VIX is rising, when the fear is rising, gold tends to outperform the S&P 500. All right, so that's how this chart was set up. Now let me go through and dissect this for you and explain the way I look at this. Number one, long term, the dollar is in an uptrend. Anyone who follows gold and follows the dollar knows that there is generally, not always, but generally an inverse relationship in the dollar versus gold. So when the dollar's going up, it puts pressure, headwinds out there for gold. So when the dollar's going up, gold tends to go down. And as you can see, since 2011, as the dollar's been climbing, gold on a relative basis to the S&P 500 has been declining. That's what I would expect. That's why over the past many years I've said I don't want gold, because we remain in an overall uptrend. However, there are pockets of times when gold can be useful, especially when we get into these highly volatile, anxious periods like we're in right now. And so what you'll notice here is that when the S&P 500 back in 2011 took a little bit of a drop there, how about 2014 took a little drop there? Remember 2015 drop, 2016? This is how the S&P, these red circles are the S&P 500 dropping. 2018, beginning of 2018, of course, the trade war started kicking in. Fourth quarter 2018, remember, big drop then, and now. So that's what I'm highlighting here. If you notice, during these periods, that's when gold pops to the upside relative to the S&P in almost every instance. I didn't mark this one right here, probably should have. That was a really good move here back at the beginning of 2016 when the market got fearful. The S&P dropped. And the things that I think are interesting is when you look at the VIX, when that 5-day moving average of the VIX moves above roughly 15, especially 20, but when it gets up above 15, the 5-day moving average, that tends to signal a time where if I was going to maybe be a little more defensive and move into gold, that's when I would do it. That would be one thing that would trigger it for me. And when the VIX starts coming back down, especially when it's below 15, the 5-day moving average is below 15, in a rising US dollar environment, I would not touch gold. And I think that history will prove me out on this. So right now we've got the dollar going up and gold going up, which is really unusual, but they're both safe havens when things are fearful. People will go into the dollar, people will also buy gold. So it's not like they move up forever. And you might see, well, some people writing, well, now we got a new paradigm, dollar and gold goes up together. No, it doesn't. The dollar doesn't go up with gold. The dollar and gold both go up when there's a lot of fear. And that's what I think this chart in most cases will show you. Almost every one of these, the dollar is also going up with gold. So keep that in mind. I spend a little bit of time, like I said, I could probably spend a lot more time on this, but all of these these blue dotted vertical lines I put in here are basically marking periods that you can see when we get the VIX breaking up above 15. There were some other smaller ones that you could do as well, but I wanted to point out some of these big moves down and the fact that gold can help during these periods. Now, I wouldn't take all of my money out if I'm longer term and I'm just, maybe I'm managing a big amount of money. I wouldn't be completely getting out of stocks and putting it all into gold. That's not what I'm trying to say, because that would be, a couple of these instances where we only go up temporarily on volatility and turn back down. That would be a mistake. So, but when you start to see that, that would be the time, maybe the light bulb going off that, hey, I might want to be a little bit more cautious, maybe sacrifice a little bit of return if the market continues going higher for the safety of knowing that I've got a hedge in place in the event that the market becomes more fearful. And as the market becomes more fearful, I wrote to all of our members in our daily market report back in the last week of February, when the S&P was just starting to roll over. I talked about the fact that the volatility index had gone above 20. And when the volatility index goes above 20, my trading goes on vacation. I don't like trading. I don't want to try to catch every move up and down. I'd rather sit in cash. I'll pick spots, trade a little bit here or there, try to make a little bit of money. If I'm wrong, I lose a little bit of money. But what I don't want to do is, bet the farm and be wrong, because that can be very costly in a highly volatile market. So anytime the VIX is up in the 20s, a light bulb should go off. Do I really want to trade this volatile market? Now, if you're long-term, again, maybe you have subtle shifts to your strategy, but you're not long-term when the market's going up and short-term when the market's going down. Personally, I think that's a mistake because then the emotions, you have so many emotional decisions to try to make. When it's going down, when it was down at 2,200, do you get in? No, I'm going to wait. I think it's going to go to 1,800. Then it's back to 2,440 like it is now. Now do I get in? Is it over? You jump in, next thing you know, back down to 2,200. Do I get back out? A lot of those questions start, jumping in, and anybody who's traded the market knows exactly what I'm talking about. During these volatile periods, it's very difficult to try to figure out from day to day, are we going to gap down 5% tomorrow morning? Are we going to be gapping up tomorrow? When the stimulus package comes out, is it already been built in? Or are we going to have another jump? It's all these questions, and then your mind really starts playing tricks on you when we get these big gap ups and gap downs, especially if the market's going against you. So my position, I've been pretty clear over the years. When the volatility index is up, especially when it gets up into the 20s, that's when I tend to say, listen, I'm going to be much more careful. My capital is my business. So I can't, I can't give away cash. You lose 20, 30% in a trading account. You got to make a higher percentage just to get back to where you were. If you're at, let's say you're at 100,000, you lose 20,000 in a trading account, you're down to 80. In order to get back to 100, you got to make 20, which is 25%. So you lose 20%, then you have to make 25% to get it back. It becomes very difficult, and you start making decisions, emotional decisions that you really shouldn't make. As far as the S&P 500 goes, I've posted this a couple of times, but I'll just go over it again here. As you look at the move down, and this is very, very similar. This is a little bit steeper, and the momentum to the downside's been just a little bit greater than what we saw in 2008 and then also in 1987. But those are the two periods that I believe this most closely resembles. It resembles 1987 more from the standpoint of, hey, we were at an all-time high, and then all of a sudden, the carpet just got pulled out from under us. And so 1 month ago, 1.5 months ago, or maybe 2 months, if you want to go back into January and say, hey, there's some things that we're starting maybe to point to a top, I'll even buy that argument, go back into January. But prior to that, we were looking at a pretty strong market. Unemployment at record lows, interest rates at record lows, GDP on the rise. All of these things were contributing to the valuation of earnings that, yes, the market was trading at a higher PE than normal. But when you're in a record low interest rate environment, earnings are more valuable. I can tell you, as with my background, having been in public accounting and valued companies before, when interest rates are low, those future earnings get discounted back at much higher levels. Just simply saying, well, the market's never traded at a PE like this, that's not a good argument. That's an argument not really understanding how earnings are valued. So I can tell you, and I said throughout 2019 when the market was getting hit, we're coming back. I would be buying anything to the downside. The market's going higher. I even went out on a limb, said the S&P was going to 4,000 back when it was 2,500 or 2,700. Probably, thought that was crazy. But by February, we were at 3,400. And if this virus doesn't come through, which obviously I can't predict that, I absolutely believe we were going to 4,000. So we still, I don't know what the economy is going to look like on the other side of this. That's the problem. If we come out of this, if somehow the stimulus package works, the virus maybe dies off and is not as bad as maybe what we're fearing based on the prices in the market right now, I could see a really big rally later this year. But I just don't think there's enough information to just go jumping in and saying, yeah, here we go. I think we've got to let some of this play out a little bit first. In terms of number of cases, rising death toll, U.S. is not near where some of the other countries, China, Italy especially, where these other countries have been, South Korea and so forth. So we've still got some, rough days ahead of us in terms of this and trying to control it. I don't have a crystal ball. I can't tell you how that's going to play out. And if we do decide to go back and, kind of in a few weeks or a month or 2 months, decide to go back out there, is it going to come back again? There's no way. I'm not a healthcare expert. Even healthcare experts don't know. So trying to decide all that is tough. What I can tell you is that when we get these massive scares like we have right now, and the S&P 500 drops 33% in 3 or 4 weeks, like we have just done, there are only a couple periods in history where we can go back and look at. And in both 2008 and in 1987, our initial bounces were up around the Fibonacci 38.2% level. That's also right about where the 20-day moving average is right now. So this combination right around 2650, the 20-day moving average 2676. Now, am I saying I guarantee you we're going up there? I am not saying that. I am saying that if we get there, if you shorted on the way down, got out, made some money, and you're looking to reshort, I think the closer you get up to this level is where I would probably be thinking about re-entering. If you're in the market and maybe you're trading, but you got caught in some stocks and now we're bouncing and you're thinking, okay, where's a good time maybe to exit on this bounce? This is where I'm thinking. So this is where I think the reward to risk shifts to the short side or to the selling side. That doesn't mean that it doesn't go through. I'm just saying that is where we can manage our risk better. Right here, I don't know. I mean, we're looking at flat futures last time I looked today. We've had a couple of these bounces. I've used the Fibonacci and said, okay, here's the bottom, and calculated Fibonacci. And I did that again here and here. And when we've gotten these moves to the upside, we haven't continued them long enough to get a Fibonacci test before we break down again. So I can't tell you if we break down again. I just know right here in the middle, after gaining 11%, we could be in for a 10, 15% move in either direction. And I don't really know which way. But I would be watching this area to the top side and this low to the downside, 2,200. All right, let's move on to earnings. A couple of earnings out yesterday and this morning. Nike came out and reported 78 cents versus 54. But remember, we're talking about in the past. This is not what they're forecasting for next quarter. This is what they just did. Well, what they just did doesn't take into account a lot of what we're experiencing and what we're going to experience as we go forward. So while it's nice looking at earnings, and I can even pull up the pre-market for you and we can take a look at what Nike's doing. It's up 11%. That looks just wonderful. After the open, I'd be a little nervous. And if we go in here, take a look at the chart, 8% takes us up to about 80. It's in this gap resistance area. Let me just annotate this and let's put the Fibonacci on here. So let's just take it from here down to here. We're going to open at, what did I say, 80, 81, something like that, right about the 50% level. If I owned Nike, I don't own it, wish I did. But if I owned Nike, I would sell at the open. I wouldn't take any chances. I would say, thank you very much. We were just down at 60 2 days ago. I'll thank you for letting me out at 81. And if it keeps going, it keeps going. But I think that it's an opportunity to take the strength and get out because we don't know what's coming. Again, just my opinion. I'm bullish. I am longer term. I'm bullish. I think we're going to, hopefully, I believe we will make the right decisions. And I believe later this year and in 2021, we'll start to see things really pick back up again. But until then, I honestly have no clue from day to day what's going to go on. And that's why I tend to stick in, cash, except a couple positions here or there. Let's take a look at another report. SNX. It's a computer hardware stock. And you can see stock's been hit pretty hard, bounced back. They did beat 326 versus 314 on the bottom line, $3.26 versus $3.14. And let's see what's going on with this earnings reaction. Down 10%. Obviously, their outlook probably was not very good, or maybe they missed revenues. I didn't see the whole report, but we've obviously got some issues. So now we're down to 73 and change here, which is right about in here. This is another one, could go either way after its earnings. We're in a wide range right now, but I would say the reaction high on this stock now at $83 is a level I'd watch pretty closely. If we can get through it, then we've got gap resistance in the 20-day like we've got in the overall market. But in the near term, since we are gapping down, or we look like we're going to be gapping down, I would be a little careful here. One last one, Paychex, PAYX. And you can see a flat look right now. Paychex did beat 97 cents versus 95. And if we pull up the chart, you can see again, almost every one of these charts are moving down. One positive I'll say about Paychex, look at the accumulation distribution, continues to rise. I've talked about this a lot. I don't want to spend a lot of time on it today, but essentially, if you're being bought during the trading day, if you're finishing stronger than basically the way you opened, that tends to be the factor that sends the accumulation distribution higher. So yes, we're down. Yeah, it doesn't look good, but I'd rather have this going up than the alternative of going down, because that tells me that we're seeing a lot of intraday selling, probably a lot of distribution. I think when we're seeing this, we have a better chance of a rally. Now, Paychex had a huge day yesterday, 18%. I think, again, 20-day moving average all the way down to price support. It's a wide range, and we're going to have this across many stocks and sectors and indices for a period of time because of the high volatility. I wish I could get rid of it, but just know when you trade, you've got a lot of risk on the other side. If you go long, you've got a lot of risk, the market going down. If you go short, I still think we've got a lot of risk back to the upside to test some of these fib levels. All right, upgrades, downgrades. I'll just give you a couple of these quickly. Apple upgraded today. Apple had a beautiful day yesterday, up more than 10%. It has been getting hit pretty well, but accumulation distribution remains pretty strong. And as far as current pre-market, up another $4 to $250. So Apple looking pretty good as it gets closer and closer to that 20-day test. We're only $10, $12 away from the 20-day, and we're $40 away, almost $40 away from the low. So the risk is starting to shift. If you're somebody thinking about shorting Apple, I think 250 up to 262, you could begin to accumulate a short position. It closes above the 20, maybe that's your stop. You got to give it some room in a volatile environment. But if you're thinking of shorting, you want to let these stocks run and rebound. It's like a rubber band that's snapping back right now because they've been so beaten down. All right. I'll just point out Coca-Cola, Hershey's, Lockheed Martin, McDonald's, TGX, Love, which is Southwest Airlines, all upgraded. Downgrades include Bank of America, Marathon Oil, downgraded twice. Sleep Number was downgraded. Teladoc, which has been a pretty good performer on a relative basis of late, downgraded today. And SNX, I talked about that one, just reporting earnings. They've been downgraded. 3 you must see. I'm just going to go over 3 of the best scooter scores, starting with one of the best small cap scooters, and that's CCXI. It's down 4% pre-market. But here you can see it is going sideways. Does have pretty strong accumulation distribution, but it's testing its 20-day. So far to this morning, you see coming back down from that. Want to be careful with that 20-day. I'm not a big fan of technical indicators right now because the market's so fearful, but I do think that the sellers have control, and if they see anything that suggests they should get aggressive again on the short side. They're going to do it. The 20-day moving average is one thing I'd watch closely here. Tesla, the top rated stock right now in its asset class. Kind of hard to believe after going from 950 down to 350 that you would still be the top rated. But remember, the scooter is a formula-based tracking system. It's looking at your where you are today relative to where you were back a couple months ago, and then a few months ago, or maybe about a month ago, and then and maybe 5 months ago. So you're looking back at how much growth, the rate of change, and how much you're trading above or below certain moving averages. You can go back and look at the formula. But it is just a formula, so there are limitations. And so when Tesla made this huge run, it almost guaranteed that it was going to remain one of the top scooter stocks for a period of time. Now, if this continues, you will see Tesla rapidly begin to deteriorate in terms of its scooter score. It's just the way the formula works. But again, Tesla, let's watch up there around that 550 level. And then the last stock I have, REGN, which is the large cap top performer. And when I look at this earlier in March, very strong accumulation distribution. I think the stock is simply consolidating. I'd watch maybe 415, 420 to the downside, but I expect that this is going to continue to be a pretty good stock. I think it's NIH, one of the health organizations, working with REGN on the coronavirus vaccine. So that's why the stock has continued to trade pretty well. But and it's a long term. It's a big biotech, been around a long time. So there is a little bit of safety in that as well. It's not like some of these smaller biotechs that are trying to do something with the coronavirus. Anyway, that is about it. Let me just show you a quick update where we are right now. Dow's up 260. S&P and the NASDAQ both pretty flat. Small caps barely up. Mid caps up about 0.75%. So trying to extend yesterday's rally. Watch those levels I talked to you about on the S&P and on all these charts. Watch those falling 20-day moving averages. Watch that Fibonacci retracement level on many stocks. I think that 38.2% up to 50% level is going to be a really hard area to penetrate on the first try. Anyway, everybody have a great day, and we'll be back. I'll be back tomorrow over at Stock Charts TV. It will be a pre-recorded session around 7:30 in the morning that will then be aired at 9 a.m. I'm trying to accommodate Stock Chart schedule. They are out in the Seattle area, which has been hit very hard by the coronavirus. So they're working off site. So some of these recordings are necessary right now. But we're still trying to get information out to everybody. And I think they're doing a great job over there. So I will be back there tomorrow, and I'll be right back here on at EarningsBeats for Trading Places Live next Monday. Mondays and Wednesdays here at EarningsBeats, Tuesdays and Thursdays at Stock Charts. Everybody have a great day, and be safe, please. Happy trading.